Hi, everyone. This is Dr. Gregory, and this is ACC4620 Auditing and Insurance 2. And we're going to cover very briefly Chapter 4, which covers the professional and legal liabilities regarding auditors. I want to tell you the story of Enron. I'm not going to get too deep in the weeds because it's a very complex story, but I want to tell you about the end of Arthur Andersen as a result of the Enron scandal. Arthur Andersen started out working for Enron out of Houston, Texas, as an external firm. And then over time, Enron was hiring Arthur Andersen auditors as their staff. So it almost became that they were performing both an internal and external audit function because there was this relationship going on. Now, especially in Houston, Enron was probably Arthur Andersen's largest client. So when you have basically one client who is your major revenue source, things can get a little sticky. There might be some issues coming up, and for Enron, it was questionable accounting practices that the firm was doing using special purpose entities. And like I said, I'm not going to get into that because it's pretty complicated. They were doing special purpose entities and they were moving assets around in these shell companies and making it look like Enron was performing better than it was. Now, the problem is that Arthur Andersen sort of took a blind eye to this. They knew it was wrong. They were kind of sort of told it was wrong, but they did it anyway. And Arthur Andersen, I believe, in fear of losing a major client, ended up being very complacent in the performance of their job. Now, what made it worse was when things got really bad and they were being investigated, the firm was caught obstructing justice because they were actually shredding documents. They were shredding work papers. And that's a huge no-no with accounting firms. But I think that Arthur Andersen was getting pretty desperate at that time. Now, eventually, the Supreme Court overturned the conviction, but the reputational damage was done to Arthur Andersen. And as a result, the company ceased to exist. They surrendered their license to perform as CPAs in 2002. Now, while we all know that Enron lost shareholder money, retirement plans were wiped out, and they lost 5,000 employees, Arthur Andersen lost 28,000 jobs in the closing down of that business. So it was a really harsh reality for auditors and accounting firms when that occurred. We were pretty much devastated by it, and we lost reputational credibility throughout the profession. So let's talk a little bit about the legal actions that can come against you as an auditor in the course of an audit. We have different kinds of liability. Now, the courts have two kinds, proportional and joint and severable. And proportional means that if you are found at fault for committing 30% of the negligence in the action, the plaintiffs can be awarded 30%. You would have to make up 30% of the damages. Okay. So it's based on how much you contributed towards the action that they brought against you. Now, in joint and several liability, the problem is that you're all held jointly to the liability. However, in some of these cases, or most of these cases, the company that is at fault is usually bankrupt. And as a result, they have no assets. So even though you may have only been 30% at fault in your role in the damages, if the other entity is bankrupt or has no assets, you absorb 100%. So you are joined regardless of the condition of all of the parties to the damages. So the surviving company, usually the audit firm, has to absorb the loss. Another type of legal action I've been involved with are class action lawsuits, and that's where multiple people of a same class join together as one entity to sue someone else. I worked on a class action lawsuit where we were actually the defendants of the class action lawsuit. And we had over 1,000 people or businesses in that class action. And it was against a governmental agency, and that governmental agency was found at fault. So we had to pay back the members of the class or any member that tried to become a part of the class some portion of damage. What it does is it reduces the number of lawsuits. So instead of 1,000 separate lawsuits, they conjoined into one. The final one I want to talk about in liability is contingent fee compensation. Now, you've seen this. I see this all the time. I live in Nevada, and Nevada has a lot of billboards and commercials for lawyers if you are injured either working in your job or if you're injured in a car accident. And they always say, we'll get you this fee. We won't take more than half of what you get. We'll never take more than what you would get in your share of it. So it's the promise that they will not take more than what they are to be awarded for. Now, what this does is they only take the case if they know they're going to win. They're not going to take the case if there's any prospect that they're going to lose, because they're out the money until the case is won. So basically, you are going to pay them back instead of fronting them for contingency fees or retainer fees. You're going to pay them at the end of the lawsuit. And it's usually a third, but it can be as much as 1/2 of the damages. So they take a large chunk. But what they're doing is they are hedging the bet that they're going to win the case. Finally, we're going to cover 3 little pieces of law: contract law, common law, and statutory law. They're basically the 3 that we find ourselves under as auditors or accountants. Contract law is just, in some way, there has been a breach of contract. So you have a contract between you and your client, and it's sometimes based on performance, or it could be that you failed to keep your client confidential. Maybe trade secrets went out that shouldn't have gone out. You failed to identify a material error. Not that you just failed to identify an error. It has to be material in nature. And that there is some liability now to the client. But it's based upon the contract that you write up. So always be sure that you're writing up your contracts or your engagement letters, which is your contract, very carefully so that you can make sure that you do not have a breach of contract. Common law is usually based upon some level of negligence to a third party, such as shareholders, creditors, vendors. The creditor extended a bank loan to the client based on your financial statements, and you're sued because you knew or should have known that the financial statements were misleading and the third party suffered a loss. And finally, statutory law is just laws based on government entities. The SEC has the Securities Acts of 1933 and 1934 that are still in place today. The IRS has certain laws regarding the filing of taxes. We have the Sarbanes-Oxley Act that talks about how management is to report their internal controls and how the auditor is supposed to ensure that those internal controls are running efficiently. So these are the different types of laws. As always, I don't go over in depth all of the chapter, but I do try to bring out some of the highlights. So if you have questions, please reach out to me. Have a great week, and I'll see you in the classroom.